November turned out to be an extremely volatile month for global markets. Global markets saw widespread losses in November, with cryptos and big tech stocks declining the most. Most assets fell sharply, rebounded, but still closed the month in negative territory. But in the last few trading days, last month ended with an everything rally on Federal Reserve rate cut bets. Now heading into December, don't fight the Fed and don't fight AI remains the market mantra. Well, it wasn't just stocks that rose. After a bumpy stretch marked by fears of bloated valuations, wild speculations and artificial intelligence over-promising bonds, commodities and even Bitcoins advanced late last week in one of the strongest cross-asset rallies of the year. Last week's move echoes recent cycles in which big bouts of turbulence ended up as a buying opportunity. Assets of all stripes rebounded with forces this week, with stocks, bonds, Bitcoin and commodities staging a coordinated advance. But for the month, only gold showed any real advance, rising 6.5% to trade around $4,256 an ounce. Bitcoin took the biggest hit with a slump of 17%. Crude extended its significant declines, with November marking a 3.8% fall. Now shifting focus to the Asia-Pacific stock markets, only Indian stocks showed any strength, while Indian benchmarks pulled back after hitting fresh all-time highs. The Sensex ended November with over 2% gain. The Japanese index took the biggest hit in Asia, crashing over 4%, followed by the Aussie benchmark. Now, the feud between Japan and China did not spare mainland stocks in Beijing. The Chinese index fell 1.7% last month. Still, Wall Street biggies have increased their bets on China's stocks. Now, in the Americas, the S&P 500 closed out nearly flat, while the tech-heavy Nasdaq was a drag with a 1.5% loss in November. After a volatile stretch marked by anxiety over speculative excesses and lofty valuations in the AI sector. Shares in heavily shorted companies surged. Crucially, Google parent Alphabet's high-profile release of its latest AI model helped restore confidence in big tech's innovation cycle. Even a trading halt on the Chicago Mercantile Exchange failed to slow the momentum on Friday. Canadian stocks showed a significant revival, with gains of 3.7%. The Brazilian Bovespa surged 6.4% last month. Across the Atlantic, all European benchmarks closed out last month nearly flat. Shares in Germany were bailed out from deep red, closing from a global pullback last week. Trading is over for the month of November, but heading into December, the biggest losers appear to be those bearish folk who bet big on a widely anticipated tech bubble blowout. With the Fed set to cut rates, the sentiment has shifted to a more positive tone, even in Europe. Separately, the South African benchmark ended November 1.6% higher. Well, having looked at market moves, let's now turn to the overall economic outlook. India remains the fastest growing major economy, with the latest data underscoring that sentiment. GDP for the September quarter was better than expected, 8.2%, marking the best rate in 6 quarters. And that despite President Trump's 50% tariffs on Indian exports. However, a day before the GDP release, the International Monetary Fund raised questions on that data. But the outlook for other countries in Asia was negative, with Trump's trade brinksmanship skewing economic bets. Despite the latest temporary truce, China's economy continued to be a drag. The deep recession in China's property sector continues to deepen. While Japan is expected to flush the economy with a massive fiscal stimulus plan, the outlook remains negative. In the Americas, the buzzword is uncertainty. The US said that losses data will be released only 10 days after the Fed meeting. Still, late November, bets revealed that expectations the Fed will ease in December. Through November, a deep divide within the Fed was reflected in bets swinging between a cut and no change in December, while the central bank is worried about driving in from fog from the lack of data. Other private data points to a weakening economy. Elsewhere, the outlook for Canada, Brazil and Argentina is still negative because of Trump's policies. Meanwhile, in Europe, Florence or Frankfurt, every place in the region is seeking to push through the much-needed reforms. Europe's growth engine, Germany, is still stuck in stagnation. It has taken a long time, but Berlin has finally recognized the economy is facing not just a cyclical downturn, but a structural period of weakness. What Germany does will dictate Europe's fate largely. Well, surprise UK budget gives the country a little bit of leeway, but the economy continues to struggle. The size of most economies in Europe are still well below their pre-COVID levels. European countries quickly needed a clear long-term strategy and less wishful thinking with the full pockets.